Hey everyone, welcome back to the Koo Trading Desk. I'm Maya, here with Vid. Okay, so I'm looking at the market this morning and the Fed literally did nothing. They held rates, everything's stable, but somehow everyone on Twitter is freaking out. Why?
Haha, well, did nothing is actually the answer. Okay, so here's the real story, Maya. The Fed just told the world, yeah, rates are staying where they are for a while. And that for a while part, that's what people are parsing.
Okay, but rates are just a number, right? Like, why does a number the Fed picks move my stocks?
Great question. So imagine you have $1,000 and two places to put it. One is a savings account that gives you 5% a year, totally safe, zero work. The other is the stock market, which might give you 8%, might give you -5%. When the Fed raises that savings rate to 5%, suddenly the safe money looks way better, and stocks gotta work harder to win your dollar.
Oh, so when rates go up, people go, actually, why am I taking the risk?
Exactly. You just nailed it. And the flip side, when rates come down, suddenly bonds are boring, so everyone floods into stocks looking for returns.
So it's like gravity. Rates go up, money flows away from stocks. Rates down, money flows in.
Perfect analogy. And here's the kicker, the stock market knows this already, so it doesn't wait for the Fed to move. It moves before, based on what it thinks the Fed will do next.
Okay. So what's actually happening right now? The Fed held. Oil's down because of Iran. Dell just crushed earnings and jumped 34%. What's the real story?
So the Fed held at 5 to 3, 75%, which is what everyone expected. No surprise, so no huge spike. But here's what's interesting, the Fed's tone is still hawkish. They're basically saying, we might hold here through 2026 and into 2027. And the market is reading that as, okay, stable for a while.
And the market's cool with that.
Yeah, because earnings are actually holding up. You saw Dell jump 34%, right? That tells you investors don't care about rates as much if companies are printing money. Same with oil dropping on Iran peace hopes, less geopolitical chaos, which helps stocks overall. The Fed's boring signal is actually good when corporate profits are strong.
So earnings beat the rate story.
They can, yeah. When you've got strong earnings and a stable rate environment, that's like the perfect setup. No surprises, no drama, money just compounds. But here's where it gets spicy, and this is what traders are quietly worried about.
Oh man, here we go.
If inflation pops back up, and we're seeing some hints, then the Fed can't cut. They might even hold higher for longer. And suddenly, a stock that costs 30 times earnings looks way too expensive when your discount rate jumps.
Wait, walk me through that. If rates go up, why does a stock suddenly look pricey?
Sure, imagine a tech company earning $1 per share. When rates are 5%, you say, I'll pay $30 for that. But if the Fed signals rates might jump to 5%, that same future dollar is worth less to you today, so you'd only pay $24. The company didn't change. The rates did.
So higher rates mean I'm less willing to pay for future earnings.
Bingo, you got it.
Okay, real talk, what actually happens next? Are we in trouble?
I see three paths. 1. Earnings stay strong, Fed holds steady, we're in Goldilocks land. Rates aren't going anywhere, companies keep winning, stocks grind higher. Boring and profitable.
Scenario 2.
Inflation surprises everybody. CPI comes in hot. Fed flips from patient to we need to keep the brakes on. Money that was flowing into growth stocks goes, wait, 25 times earnings valuation. For real. You'd see maybe a 5 to 10% pullback in the mega-cap growth names, the expensive ones.
That sounds rough.
It's a normal market hiccup. Happens every couple years. Third scenario, what if we get a recession signal? Fed freaks out and starts cutting in 2026 instead of 2027. That usually triggers a big relief rally.
So recession could actually be bullish.
In the short term, yeah. because the market's already priced in Fed holds through 2026. If they start cutting early, that's a positive surprise.
Wow, so the Fed's basically managing our expectations.
That's like 99% of what they do, yeah.
Bottom line it for me, what should someone actually do?
3 things. 1. If rates stay put and earnings hold, stocks are your friend. 2. Watch inflation like a hawk, that's the real trigger. 3. Remember the Fed cuts when things get scary, not when they're good. So recession talk actually means rate cuts are coming, which helps stocks.
So don't panic if the Fed talks tough. They're trying to keep things safe.
Exactly. They're like the bouncer at a bar, seem mean, but they're just making sure nobody gets crazy.
Haha, I like that. Okay, so just to recap, the Fed's rate decisions matter because they change what investors will pay for stocks. No surprises, market yawns. Surprises, big swings. Right now, earnings are doing the heavy lifting, so rate staying stable is actually fine.
That's it, you nailed the whole thing.
Cool. Quick reminder, friends, this is educational content only, not financial advice. Do your own research, talk to a pro before you make moves. And if you want to hang with us, we've got a Discord. Link in the notes. Vid, anything else?
Just stay curious, keep asking questions. The stock market isn't magic. It's people trying to predict the future and changing their minds every time new data drops.
Love it. Thanks for breaking this down. See you next time on the Koo Trading Desk.
See you, Maya. Thanks, everyone.